If you're retired or about to retire and you're really worried about all the taxes that you are going to pay over your lifetime, don't worry. I'm going to show you 3 of the most powerful tax planning strategies that could help you save potentially hundreds of thousands of dollars in lifetime taxes. And I'm also going to give you one bonus one at the very end too. So let's go ahead and jump right in. So the first tax planning strategy is called asset location. That's a fancy way of saying, where do you put your investments? You see, most people, I would argue probably 90% of the people watching this video, consider what investments to pick. We spend a lot of time on that, but most investors spend zero time on where to put those investments to minimize their taxes. If we take the 3 standard types of accounts, our tax deferred accounts, our taxable accounts, and our tax-free accounts, we can quickly understand where to actually put our investments to pay the least in tax. In a tax deferred account like a traditional IRA, you're going to pay ordinary income rate on that account. That's generally speaking the highest level of taxation that you'll pay. In the brokerage account, you qualify for long-term capital gains tax treatment, which is about 15% for most people. And in the Roth IRA account or your tax-free account, you actually have no taxes in that account on all of the gains, no matter how high those gains are. And so when I'm sitting down with a client and we're evaluating their investment portfolio and I'm showing them the investments that we want to buy, I'm also taking it a step further and showing them where are we going to put those investments to minimize their taxes. Now, generally speaking, in a tax deferred account like a traditional IRA, we want to put our slowest growing assets in this account. So things like US Treasuries or corporate bonds or even money market funds sometimes. Now, why is that? Well, because that account is subject to the highest level of taxation, the ordinary income rate tax, we want to put our slowest growing assets in that account. So those assets we still own, but they're always subject to the least amount of tax because they're not appreciating very much. In our taxable account, like our brokerage account, we want to put tax efficient investments. Why is that? Well, the brokerage account, remember, is a pay tax as you go account. Every year that you accumulate dividends or interest or capital gains, you're going to pay tax in the year that you realize those gains. That's not true for your traditional IRA or your Roth IRA, where the traditional IRA is tax deferred. So you can recognize all the gains you want. You don't pay tax until you pull the money out. The brokerage account is different. You pay tax as you go. So we want tax efficient investments in here. Think ETFs, for example, right? Those are very tax efficient investments, and I like to put those in the brokerage account when I work with clients. Another tax efficient investment are muni bonds. Muni bonds or municipal bonds are bonds or IOUs issued by your state and local governments. The interest on those bonds is actually tax free. There's a little nuance to that, so they're not always completely tax-free, but generally speaking, the vast majority of the times, they're going to be tax-free. And so if we can take those muni bonds and put them in our brokerage account, where a normal bond would be subject to tax, but the muni bond isn't, well, now we save a lot in taxes because that muni bond is going to negate the actual taxation classification of the brokerage account. So now let's take a look at the Roth IRA account. In a Roth IRA account, all the gains are tax-free. So we want to put our most aggressive investments in our Roth IRA account. So things like growth stocks or small cap stocks, we want to put those in the Roth because they have the most potential upside. And so if a stock has a lot of upside, we want to put that in the Roth so that all of that big upside is not going to get taxed at all. That's the secret to really good asset location. Our second tax planning strategy is Roth conversions, and this is so powerful for those of you who are a pre-retiree or a retiree, or even younger people. This is still a very powerful strategy. It applies really no matter what your age is. But essentially what you're doing is you're trying to create a tax arbitrage between your tax rate today and your expected tax rate in the future. So let's just use a very basic example. You have a traditional IRA, you've got a Roth IRA. If you move pre-tax money from a traditional IRA to a Roth IRA, what you've done is a Roth conversion. I do this for clients all the time. I'll sit down with a client who's in a very low tax bracket this year, and we'll say, hey, what if we moved $10,000 from your traditional IRA to your Roth IRA? Well, if you're in the 12% tax bracket this year, because again, maybe you're pre-retiree and so you cut back on your working hours, maybe you are retired, maybe you took a sabbatical. Maybe you're on maternity leave, right? So there's all kinds of reasons why you'd be in a low tax bracket today versus what you would normally be in the future. So let's say we convert that 10,000 and you're in the 12% bracket. Well, great. You'll pay 12% on that conversion. It just gets added to your income because a Roth conversion always creates income in the year that you do it. But if you're in the 12% bracket, you're only paying $1,200 on this entire conversion. And that money in the traditional IRA was going to get taxed at some point. If your expected tax rate in retirement, if we calculate that to be 22%, well, guess what? That money was going to get taxed at 22%, but because you strategically converted it to Roth funds at 12%, well, guess what? You just saved 10% in tax on every dollar that you converted. So in this example, you saved $1,000 in lifetime taxes by doing this simple little Roth conversion. Now, this is an oversimplified example, but you get the idea. Now, if you do this strategically by what we call filling up the brackets, so filling up those lower tax brackets and not exceeding them, and splitting these Roth conversions or doing them over successive years when you're in low tax brackets, you can actually convert a very large portion of your traditional IRA into a Roth IRA, pay very little tax, lower your future RMDs, and significantly lower your overall lifetime taxes. The third strategy is withdrawal sequencing. Withdrawal sequencing is trying to figure out how much tax you're going to pay by pulling from which account first and then coming up with the strategy to make that number as low as possible. So in this example, really what I just want you to focus on are the two top lines of $30,000. Now, this is a very contrived example because I just want to show you the overall concept behind withdrawal sequencing. And by the way, all of these slides that you're seeing are from the tax planning course I teach at Johns Hopkins University. If you look at household A that pulls $30,000 from their brokerage account versus household B that pulls $30,000 from their traditional IRA or a tax deferred account, what's going to happen is that because that $30,000 from the brokerage account has capital gains and a cost basis embedded in it, the entire $30,000 is not a gain. So part of that money is untaxed. Versus in the tax deferred account, like a traditional IRA, if you pull $30,000 out, all of that money is going to be considered ordinary income and it's all going to be subject to tax. And so you have to weigh the pros and cons. You have to look at where you're pulling money from first in retirement so that you pay the least amount in taxes. So withdrawal sequencing is a very powerful tax planning strategy. And it's one that I discuss with clients all the time at my wealth management firm, DocShah Financial. And by the way, if you're enjoying this content, please make sure to leave a like, comment, and subscribe as it really helps the channel grow and helps me to continue to deliver really high quality tax planning content. Okay, now for the bonus tax planning strategy, as I promised you at the start of the video, we're going to talk about a donor advised fund. Donor advised funds sound very fancy, but they're actually very simple. I have a donor advised fund, and if a client of mine wants to open a donor advised fund, I open those and manage those for them as well. In fact, I do it right through Charles Schwab. And so a donor advised fund, think of it like a bucket, okay? It's just an account. And what you can do is you can put money into the donor advised fund, and then you can distribute those funds to charity at any cadence that you want. And the beauty is that if you're not ready to give it all at one time, you can actually invest the funds and you can have that account grow and then you can distribute it to charity. Now, how does tax planning fit into this? Well, when you put money into a donor advised fund, if you put more than the standard deduction, you can actually claim the entire amount that you put into the donor advised fund instead of your standard deduction. And so you could reduce your taxable income significantly. So for example, if you know every year like clockwork, you give $10,000 to a particular charity, well, what you could do is in a year that you have a lot of income and that you're in a higher tax bracket, you could just bunch the next 5 years of donations into 1 year by taking $50,000, putting it into the donor advised fund. It's more than the standard deduction, whether you're single or married filing jointly. You get to claim a $50,000 deduction off of your taxable income, and you get to invest the money in that donor advised fund and then distribute it to the charities of your choice at the cadence of your will. That's the beauty of these funds. So there you guys have it. There's 4 tax planning strategies for you guys that can make a significant difference in your retirement portfolio and the overall taxes that you pay in your lifetime. If you're interested in having your portfolio actively managed and having these same tax planning strategies apply to your situation, just shoot me an email, Raul@DocShahFinancial.com. I'd love to hear from you and your personal situation and how I could help you. And until then, remember, like and comment on the video and subscribe to the channel, and I'll see you next time.